Hi, I'm Jimmy. In this video, we're looking at the US economy. So we're going to go through a series of different economic indicators and try to determine are they bullish or are they bearish, and ultimately try to score, let's say, the broader US economy. Hopefully, this will lead us to making better investment decisions and try to answer the question, do we invest now or do we wait for the stock market to crash before we go ahead and invest? Okay, that being said, let's jump into our first economic indicator, and this one's a big one. This is inflation. Now, this is a 20-year chart for inflation. So this inflation period covers a decent amount of time. And we can see that in about 2022, things got fairly crazy for inflation. And then it was starting to come down. This was starting to look better and better. But just recently, it kind of hit just below the 4% mark, which is better than 8%, 9%. But it kind of moved sideways for us. And this could really be a problem. One of the reasons that the Federal Reserve was increasing interest rates was to try to offset rising inflation. There's talk now about them decreasing interest rates, which seems likely, but if inflation stays up here, that could prove problematic. If they decrease interest rates, that tends to lead to higher inflation. Higher interest rates, lower inflation. That's why it makes sense for them to try to go ahead and consider at least decreasing interest rates. But if it stays up here, this could be a problem. That's one of the reasons that for our first economic indicator over on the scorecard here, I'm giving this point to the bears. Okay, now it's real difficult to talk about inflation if we don't also consider how fast wages are growing. So this next economic indicator is looking at a 10-year chart of wage growth. The Atlanta Fed puts out wage growth numbers on average. What percentage do they grow by? Now, with higher inflation often comes higher wage growth, which kind of makes sense. It's difficult to have higher inflation without having some wage growth. And recently, so the number jumped. That's a positive sign. Now, it has started to trend down recently. But in order to determine whether or not this is truly a bullish point or a bearish point, I think we have to compare both inflation and wage growth together. So when we jump over to that chart, now again, this chart is going back pretty far. I wanted to get more data in there so we could get a better look at it from a big picture perspective. Well, we can see wage growth, that's the line here. Wage growth is in fact looking fairly good compared to inflation. For a while, when inflation was first going nuts, things got pretty bad. But recently, wage growth is outpacing inflation. So when we jump back to the scorecard, where I think we still give inflation, the pause there, a bear, we got to give this point to the bulls. So I think it makes sense to kind of split these one for one. But I am very curious everybody's opinion on these. If you disagree with the way I score any individual chart, let me know. I'd be curious how you would rescore this. Okay, now wage growth is really only good for people who actually have jobs. So our next economic indicator is looking at the unemployment rate. Now, I've had a lot of pushback from people saying the youth-free unemployment rate, that's the most traditional, most headline number, is not the best number to use. But instead, something like U6, which also tracks people that are, let's say, not quite looking for work, like they don't meet the same stringent requirements that are necessary to count you in U3, which is why U6 will tend to be a higher number. But I also think it's important to point out that both the numbers tend to act fairly similar to each other. Now, when we look inside this most recent time period here, the unemployment rate has kind of started to rise a little bit. Now, as the Federal Reserve was as the government was increasing interest rates, rising unemployment was somewhat inevitable. It didn't get too bad, so that's a good sign. U6, by the way, is actually trending a little bit lower. To me, this is ultimately, I think that when we look at this chart, again, this chart goes back to the past 20 years. When we jump over to the scorecard, I got to give this score more of a neutral point because it is starting to go higher, which is a bad sign, but it's not that high relative to the increase in interest rates to above 5%. The unemployment rate kind of held in there fairly good. So I wanted to go bullish on this, but I was afraid the rising number could be a bad sign. So for now, we want neutral. Okay, next up, we've got debt. Now, we've actually got two different debt numbers to consider. The first one is household debt. So this is household debt as a percentage of GDP. And we can see that recently, household debt has in fact drifted lower. This is clearly a positive sign. And if we're going to stop here, this would be a point for the bulls because that number is drifting lower. But this is another way to look at it that could have perhaps could be a good indicator of perhaps future household debt numbers. But this is the percentage of credit card accounts that are 90 days or more late. 90 days or more late is a problem. If there's different economic indicators, 30 days, 60 days, 90 days. 90 days tends to be the biggest problem for credit cards. And we can see recently that number has ramped up. If we were counting this independently, this would be a bearish point where the last one would have been a bullish point. That being said, over on the economic scorecard, again, let me know your thoughts in the comments below, but I got to go neutral here. We had one positive, one negative. We could have split them and done it that way, but I think this kind of addresses it. Debt is something that should be watched, but it potentially, with the 90-day late in credit card numbers going up, that's something we should watch. Okay, now we're jumping over to one of the economic indicators that I think is one of the most important for the U.S. economy, and that is consumer confidence. So, consumer confidence, the U.S. economy is highly driven by consumer spending. The consumer has to feel confident in their economic situation. That's what consumer confidence tries to measure, their overall economic situation. They have to feel fairly confident with their economic situation in order for them to spend a decent amount. Luckily, this number recently is climbing a decent amount. Now, again, I think that this is one of the most important economic indicators for anybody to watch. If you're only going to watch a couple, this is one of them to keep an eye on. And clearly, that recent climb, that trend higher, you got to give this one to the bulls. So right now, ignoring the neutral ones, the bulls are in the lead 2-1. Okay, next up, we've got an economic indicator that looks at a specific part of the economy, and that's housing. Again, we got two different economic indicators to consider, but these ones are a little bit different. So this one's housing starts. Housing starts is basically the amount of new houses that they start building. It's really that simple. Mostly driven by like home builders, things like that. Now, we can see here that housing starts was climbing higher. Then they started increasing interest rates. It began to drop, but it kind of leveled off. Much to my surprise, I thought that those numbers were going to get significantly worse when interest rates, mortgages hit 7, 8, 9%, compared to just a couple of years ago, 2, 3, 4%. I thought that was going to get worse than it did, but it kind of held in there. So for me, that's a positive sign. The fact that it's trending sideways at these higher interest rates, and if the Federal Reserve does decrease interest rates, this could get even better. That being said, let's look at the other economic indicator, and that is the price of existing home sales. Now, again, this is one of those that is really tricky to score. I could go genuinely in either direction for this one and say, well, when we look up at the peak here, higher home prices implies that, let's say I own a house. Well, my house has more equity, it has more value. It's, if I'm investing in houses, that has gone up. That's all positive signs. Then again, if I want to buy a house, it's real expensive now. Not only is it real expensive, but it's real expensive, and I have a higher mortgage now. So that's kind of a double whammy. Frankly, I don't know. Rising home prices generally, academically, is looked as a positive sign for the broader economy. If home prices were falling, that would be a bad sign for the broader economy. So academically, this is a good point, but I could also see the hesitation. There was a real big jump coming out of 2020, and I'm a little surprised it didn't correct more with rising interest rates. Although it is possible that over the next few years, that those numbers just kind of trend sideways as, let's say, the long-term trend were to catch up to it. But jumping over to the scorecard, when we consider both home prices and housing starts, I think we got to give this one to the bulls. Okay, now let's jump over to manufacturing. So this is the ISM Manufacturing Economic Indicator. The most important line here to pay attention to is the 50 level. Anything above 50 implies positive growth. Anything below 50 is negative growth in the manufacturing sector itself. So we're looking very specifically at the manufacturing sector. Now we can see that recently it was below the 50 level, but it's kind of right now. I kept the line a bit back so we could see it a bit more, but right now it's right around 50. It's slightly under it. But considering where we were before over on the scorecard here, I think you got to go neutral here. Maybe we could say bearish, but bearish to neutral, I would say. But I think it's about flat now. If it's at about 50, you're not having a lot of growth, but that's a lot better than the negative growth we were having just last year. Okay, now we're jumping over to another crucial economic indicator, and that's more interest rates themselves, and that is the yield curve. So this is a chart of the yield curve that tracks what the interest rate is for each individual time period. Now, the most important thing for us to look at, if you're ever looking at a yield curve, and there's all sorts of yield curves. You could look at corporate bond yield curves. You could look at treasury yield curves. There's all sorts of yield curves out there. But the key to this is the shape of the yield curve. Right now, the shape of this is clearly down. They call this a negative yield curve. A negative yield curve is real bad for an economy. The joke out there, the economic joke, is that the yield curve has predicted like 5 out of the past 4 economic recessions, which means basically the long and short of it is if it goes negative, that doesn't necessarily mean a recession is coming. But every recession that we've had in like the past 100 years has been preceded by a negative yield curve. So while it doesn't have a perfect batting average, it is a good sign of it, a good indicator of a potential recession. So clearly, this is going to be a problem. So over on the scorecard, this one's a layup. This is 100% a point for the Bears. But given all the other points, given everything we've looked at so far, I think that it makes sense that the economy is in a fairly strong position. I would also point out that the yield curve has been inverted. The negative yield curve, inverted yield curve. The inverted yield curve, it's been inverted for a long time, almost coming out of COVID, pretty much since they started increasing interest rates. Because don't forget, when they increase interest rates, well, the Federal Reserve controls short-term rates. They raise up those short-term rates. The market sets longer-term rates. And clearly, the market hasn't quite caught up to what the Federal Reserve was doing. So, as if they do start decreasing interest rates, it is possible that that yield curve normalizes a bit more. In the meantime, it's clearly going to be a point for the Bears. Now, to answer the question, do we invest now or wait for the stock market to crash? The real answer is don't try to time the market. That's always the answer. Never try to time the market. But I actually think that the market right now, the economy, not the stock market, the economy looks decent, broadly speaking. There are some things that we got to keep an eye on. Potential unemployment going higher, inflation not dropping quite enough. And there's some points of worry, as is true in every economy. But broadly speaking, things look fairly good. The real problem I think we're facing right now is that many different stocks are overpriced. So ideally, we want to find stocks that are undervalued, or perhaps find sectors that are undervalued. So going forward, I'm going to be doing a lot more videos. I took a long hiatus there while we were working on putting up our website and getting all that to work correctly. But going forward, we're going to be putting out a lot more videos on different company analysis, things like that. Let me know if there's any companies that you think I should research sooner than later and see if we can find some of those opportunities that I think that the market is presenting us right now. We got to find good undervalued stocks. Now, if you're not sure how to research a stock, I actually did a video called 8 Steps to Analyze a Stock right over here. This is the process that I use. This is the step-by-step guide of basically, if you're not sure, if you're brand new to a company, how do you research it? Where do you find the information? Things like that. Besides that, thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.